Mohammed, very good to have you with us. You are leading SFO Capital Partners, and you have done quite a lot of deals in the last few years. What can you tell us about the company?
Thank you, Gustavo. It's great to be here. As a company, we're based in London. We've bought about $2.2 billion worth of assets, predominantly investing in the US and in Europe across a series of strategies. Last couple of years have been challenging but also interesting. Being based in London and operating on two continents, in the US and in Europe, the US typically reacts a bit faster than Europe when it comes to adapting with the changing macroeconomic environment. So we're able to adapt and experience changes in the US a bit earlier than we are in Europe, which helps us in some way. So now we're at a stage where we're further institutionalizing our business, getting ready for the next cycle, looking internally on how we can improve if there are areas of improvement, how we can institutionalize. We moved recently to a more functional leadership model. So the experiences we're gaining today are allowing us to focus more internally on doing long overdue initiatives that will allow us and position us for future growth. I'm optimistic today, Gustavo. Sure, there is inflation is still there. Interest rates are still high. It's taking longer than expected for most of us. We were here last year and we were expecting things to start to cool down earlier. But we're seeing opportunities that we haven't seen before. What differentiate, I don't know if I would say differentiate, but what I like the most about our firm is the fact that we're nimble and agile. We're able to adapt.
Now, when you talk about the level of the interest rate, the perspective of recession in the horizon, what's the best strategy? How are you planning on going about deals? Also the challenge about refinancing. How do you see this market situation and how you plan on navigating?
I mean, our key strengths today is that we were able over the past 10 years to adapt to different situations. While we started investing actively in the office segment and predominantly on the value add side of things, acquiring assets, repositioning them into ESG compliant, energy efficient buildings, where we felt there was a great opportunity at one point. We moved later on into the residential segment, which enjoyed very strong fundamentals, continuous demographic growth and significant supply and demand shortages. Further after, we moved into the logistics segment. And today, to take advantage of the macroeconomic challenges, we feel that credit is the best priced, and we are most active today on the private credit side. So that's what I like about real estate, is that depending on the different stages of the cycles we're in, there's always a sub-segment that tend to perform better. As long as you have the agility and the adaptability required, you can always move and focus on a certain segment, which will allow you to achieve the risk-adjusted returns that you are seeking for your investors and for the firm.
And would you say there is any specific asset class that you believe will perform better than the others? And is there any other asset class that you would rather stay away?
We have never invested, but we haven't really focused on retail. So for us, it's not one of our core strategies. So we're not the big retail or hospitality investors. Now, staying away from an asset class, when we look at office, resi, and logistics, I wouldn't say I would stay away. I would still look at all these asset classes. I think that, at the contrary, there are opportunities that in the past that were overpriced for us, at least for our cost of capital, which today are becoming more interesting. But if I had to select a single asset class that I would continuously look at, and as a firm will continuously remain focused on, obviously it's residential. It's long-term fundamentals, it's supply-demand dynamics that are extremely favorable. It's an asset class we understand. We've acquired over 8,000 units of residential between the US and Europe. it's a dynamic asset class. And the second asset class I'd look at, and I continue to look at, is the logistic. Obviously, we all know the story around the e-commerce penetration is still much lower in Europe than it is in the US. So on the European ground, logistic is definitely a sector we are very focused on today. So these are the two sectors, and we're looking at them today both on the equity side, but also on the credit side, and more specifically on the mezzanine lending side.
Perfect. Let's suppose you bring your crystal ball to the table here, and we think about where are we gonna be in 12 months. The next time we are here in Paris together, we have here 700 senior executives talking about the market conditions, sharing their thoughts and ideas, and very often we think things will go one way and they go another way. Where are we gonna be in 12 months' time?
The consensus is that interest rate will start to taper, at least towards the end of the next 12 months. If it does, that's great. That's at least where consensus is. For us, we're assuming that it won't. It will more or less be where it is today. And we will underwrite and we will invest on that basis. And if we're able to be in a macroeconomic environment that is better, more enhanced, that's great. It's upside for us.
Thank you very much for your support. Pleasure speaking to you.
Thank you, Gustavo.